Welcome to Public Sector Accounting. Today we're focusing on Ipsas 36. Ipsas stands for International Public Sector Accounting Standards, the rules for government financial reporting. These standards ensure financial information is clear, consistent, and comparable across public entities, supporting transparency and accountability. Ipsas 36 specifically addresses investments in associates and joint ventures, situations where a government agency owns a significant but not controlling stake in another entity. The standard provides guidance on how to record and update the value of these investments in financial statements. The goal is to accurately reflect the government's financial relationship and share in the performance of these entities. It's not about control, but about having influence. This gives taxpayers a clearer picture of the government's financial position. In this guide, we'll break down Ipsas 36 into simple parts. We'll define associates and joint ventures, explain the equity method, and walk through practical examples. By the end, you'll understand the core principles and how to apply them. Ready to master Ipsas 36? Let's get started. Let's clarify when Ipsas 36 is used. An associate is an entity where the investor has significant influence, meaning participation in policy decisions, but not control. A joint venture is a partnership where two or more parties share joint control, requiring unanimous agreement for major decisions. Ipsas 36 applies to investments in associates and joint ventures, where you have influence but not full control. Typically, significant influence is presumed with 20 to 50% ownership, less than 20%. Likely no influence. More than 50%? That's control. And Ipsas 35 applies. Ipsas 36 does not cover subsidiaries, full control, or passive investments, no influence. It's for that middle ground where you have a say but not the final word. This makes Ipsas 36 a specialized, essential standard for public sector accounting. Now, how do you apply Ipsas 36? Use the equity method. The equity method starts by recording the investment at cost. Then, adjust the carrying amount to reflect your share of the associate's or joint venture's profit or loss. If the associate profits, your investment value increases. If it loses, your investment decreases. This method shows the economic reality of your influence. Your stake rises and falls with the entity's performance. Unlike consolidation, you don't combine all assets and liabilities, just show the investment as a single line on your balance sheet. Your share of profit or loss also appears as a single line on your income statement. The equity method keeps your financials dynamic and relevant. Let's see the equity method in action. When you acquire an associate or joint venture, record the investment at cost, the amount paid or fair value of assets given. Example: a city government invests $100,000 for a 30% stake in a public utility, an associate. Journal entry: debit investment in associate $100,000, credit cash $100,000. At year end, if the associate earns $50,000 profit, the city's share is 30%, that's $15,000. Increase the investment by this amount. Debit investment in associate $15,000, credit share of profit from associate $15,000. This links your financials directly to the associate's performance. The equity method ensures your statements reflect real changes in value. What if the associate reports a loss? You recognize your share, reducing the investment's carrying amount. Example: the associate loses $20,000. Your 30% share is $6,000. Journal entry: debit share of loss from associate $6,000. Credit investment in associate $6,000. If losses reduce the investment to zero, stop recognizing further losses. Now let's talk dividends. Under the equity method, dividends are not income. They're a return of your investment. When you receive a dividend, reduce the investment's carrying amount. Example: the associate pays a $10,000 dividend. Your share is $3,000. Journal entry: debit cash $3,000. Credit investment in associate $3,000. Dividends don't appear as revenue. They simply convert part of your investment to cash. This approach avoids double counting income. Sometimes, an investment's value drops for reasons beyond normal losses. This is impairment. Ipsas 36 requires you to test for impairment if there are signs the investment's value has declined significantly and permanently. Indicators include financial trouble, adverse market changes, or a prolonged drop in fair value. If impairment exists, write down the investment to its recoverable amount. Example: carrying amount is $106,000, but recoverable amount is $70,000. Recognize a $36,000 impairment loss. Journal entry: debit impairment loss on investment, $36,000, credit investment in associate, $36,000. This ensures your balance sheet reflects the true value of the investment. 10. Good accounting isn't just about entries, it's about transparency. Ipsas 36 requires detailed disclosures in your financial statement notes. Disclose the nature of your relationship with associates or joint ventures, why you have significant influence, and summarized financial info for each. State that you use the equity method and note any restrictions on fund transfers or risks. These disclosures help users understand the scope and risks of your investments. To recap, use the equity method for associates and joint ventures. Record at cost. Adjust for your share of profits or losses, reduce for dividends, and test for impairment. Proper application and disclosure ensure your financial statements are accurate and transparent.